Speculation always leads to bubbles, and we are seeing this quite evident today. We saw this many times historically, typically seen with the dot-com boom, where there was no semblance of reality in the economy, yet the prices continued to rise. So today we will discuss the bubbles that are present today in the global economy. You came here for the truth, so let me unveil that for you. All of these charts are out of investor.ch, so I want to give them credit for this. And let's take a look at some of these charts. You can see the biotech sector fantasy, and we're looking at the dot-com boom back around the year 2000, where they also had an extremely high rise, and the rate at which they increased really mimics what has happened here once again. The data was stagnant for many years following the dot-com boom, and then all of a sudden, after the financial crisis, when everything in the world began to rise, so did biotech. But what exactly have they found? What kind of major discoveries have there been since this time? And the fact is that there really hasn't been any fundamental real differences here. This is all speculation that has been going on, and we're seeing the rate at which it's increasing to become exponential, and that is very worrisome. Look at where it was during the financial crisis, being at about 1,000 here on the chart, and then it's moving up to near 4,000, and that's only a few years. A quadrupling in price for an entire sector is not reasonable. So let's move on to this, and this is sort of a fun little one, but football players versus the world political leaders. And you can see how, for example, number 3, Barack Obama making $400,000 per year, compared to this player Ibrahimovic making $40 million a year, and he is certainly making 100 times more. But what does this go to show you? That there is an overvaluation of the things that really don't matter. They're being paid so much. Meanwhile, the economies around the world are suffering so badly. They have to commit to these public works projects just to keep everything moving. Yet the problems exist here, not with a lack of money. It's simply the average citizen that lacks the money. So let's move on to this here. London real estate. London is fun, London is great, but London real estate has reached insane levels, and you can see how high it has gotten compared to the UK nationwide, and this has been going on for quite some time, but the divide has been increasing over the recent past. You can see how much of this has been going on since the financial crisis, because any disparity has gotten worse since the financial crisis, and this is very evident right here with the London stock market. And it's not just the London stock market. Look at the other places around the world. I just covered Toronto and Vancouver, how bad it can be there, and these are things that we need to watch out for. The bubbles are clearly evident. This here, the Swiss National Bank balance sheet, I cannot believe this, but they went ahead and actually admitted that they would buy as many shares of the stock market that it took in order to keep the prices propped up. And they have certainly done this here. Hard to believe, but the SNB's balance sheet has grown massively in size over the past years due to the financial crisis in 2008 and the European mess. And you can see how this has been staggering upwards since the financial crisis, and it has gone to levels that certainly outdid anything from the past. Began here during the financial crisis at about 200 and now approaching again 800. That's a quadrupling in the total assets here. This is completely unsustainable even for Switzerland themselves. So once again, we have another bubble. Long USD. Do you know anybody who's currently not bullish on the USD? And you can see that there has been a dramatic increase over the past year and a bit, whereby people have been, or investors I should say, have been dumping in money to the USD trade. And this has been going on not for that long, because over some time we have seen the US dollar fade, but in the recent past, surely it has begun to go insane. Let's move on to this defensive blue chips with high dividend yields, and they're saying that dividend stocks are the place to be, and there's always these quotes of they will never drop again. But look at the PE ratios here. You're looking at in the 20s. That is historically very high. The average PE ratio is definitely lower than this, and when you look at the .com boom, which is why I mentioned it at the beginning, we saw the PE ratios become ridiculous, and we do not want it to head into that same territory now, because that is one of the indicators that will tell us as soon as the PE ratios get too high, they become historically abnormal, we can expect things to, quote, correct. So I want to move on from this right here, just try to get through as much as I can quickly. Take a look at the Chinese stock market here. We can see how it's moving from the levels of 2,000 or 2,500 up until the 4,500 range in an extremely short period of time. In fact, just over a year that took place, and that is not sustainable whatsoever. But what's happening in China right now is that they are relaxing their lending rules, and this will make any market bounce higher. But of course, we will see a dead cat bounce. This is something that needs to be addressed. It needs to be covered, but they're not going to do so. That's certainly for sure. And this one here, the DAX index, German stocks are up 239% since March 2009. And that is certainly more reasonable than some of the other stock markets, but it is up really, really high. And the question is this valid? Isn't it reasonable? But look at the global economy, how it's suffering. Look at the real unemployment rates. Look at the jobless numbers, how many people are actually out of work. Look at the food stamp numbers. Look at the youth unemployment. Look at all these numbers, and you will have a very different picture than the ones presented to us by the governments. This right here shows a year-to-date increase of over 24%. This is very high as well, so that's something to look at. I'm going to move on to this last one, and that is shorting of oil. In fact, this is a reverse bubble, and we're looking at a decline that has been occurring. What I'm seeing here is a staggering level downward. So it has come down. Perhaps it will come up, but it really looks like this is going on a downtrend over the really the past few years. That has been happening since 2011, where it was much higher, and it has now been staggering downward to the area where it's low, and it hasn't been at this level approximately for a few years. So this is quite frightening for those who are involved in this, because of course there are many jobs that rely on a higher price of oil. The exports, of course, are very important as well. And then last but not least, just wanted to get to this. It's not a bubble, but they're just a reminder of the typical financial bubble pattern. You could see how, there are different things along the way. I don't want to get into all of them. You can read this for yourself, but essentially, once we get to the top, we have this new paradigm. And this new paradigm is something that we're always facing. They always say the stocks will never decline. We have a permanent level of growth that is taking place. Have no fear. This is okay. Don't worry about it. And so on. If we take the US dollar, for example, or perhaps anything else, you can match it up with this chart and see how it compares. When everybody in the world is betting one direction, you know that you should probably be heading in the other direction. In my book, I have a similar chart where I believe that there are actually 3 stages in any bull market. And what I say is, suddenly it becomes the best investment to own by every financial analyst. Near the end of the bull market, your barber, taxi driver, and neighbor's 8-year-old son are telling you that it's where the money is at. this is when you begin to sell. So what we have here is the 3 stages. In stage number 1, absolutely nobody is interested in it. It's considered the worst investment in the world. During stage 2, they start to pick up on it. The media begins to cover it, and it really gains some steam, but it's still not what we would see in a typical, what they would call a bull market. Like, for example, the S&P is really in stage 3, because this is when it's euphoric, when nobody else is taking that contrarian bet and everybody is just going long on these items here. You know that is stage 3 of the bull market. This is something that is loosely applied to each bull market because they're all, of course, different, but the general idea is there. So I hope that you found this informative. If you did, please give me a thumbs up. I really appreciate them a lot. I'm trying to get back to all of your emails. I ended up emailing every single person out of the insiders, and now I'm getting back to the people from the Money GPS email that I have. So I'll try to get to everyone on there. There are emails that are well over a week old in there, but have no fear, I will get back to you. It just takes me some time. If you want to get a hold of me, that is david@themoneygps.com. But the better place to get a hold of me is on the insiders. And in order to get on there, all you have to do is go to themoneygps.com, scroll down to the bottom, fill in your email address, and you get occasional emails from me with good, short, concise info.